You've probably seen it on YouTube or TikTok. Buy, renovate, rent, refinance, repeat. The famous BRRRR method. But here's the truth no one wants to say out loud in 2026 Montreal. Most of what people call a BRRRR isn't one. It's just a renovation with no exit. If you want to pull money back out of a deal, you need to buy it right. Renovate with a plan and hit your value targets on time. In this video, I'm going to walk you through exactly what makes a Montreal property a real BRRRR deal using real math, real lender rules, and today's conditions. Hi, I'm Aguinaga, Montreal real estate broker and investor. I've worked with dozens of investors building portfolios using the BRRRR model, some successfully, others who learned the hard way. I've also done these deals personally, so I know the stress when your refinance is late, or the reno budget slips, or the value doesn't come in as expected. That's why today's video isn't theory. It's a no-fluff, boots-on-the-ground breakdown of what makes a BRRRR work in 2026. So let's start with the basics. A true BRRRR means that you buy under market value, ideally with cosmetic or strategic upside. You renovate in a way that adds appraised value, not just looks nicer. You rent the units at the pro forma amounts in a timely manner. You refinance at a higher valuation and pull out a chunk of your initial capital. You hold the property with positive or neutral cash flow, and then repeat with your original money back in hand. If your refinance only covers a portion of what you put in, or your reno doesn't justify the uplift in value, it's not a BRRRR. It's just a reno flip without selling. Let's walk through an example. You buy a duplex in the South Shore for $470,000 with $30,000 in renos planned. Your after repair value, ARV, is expected to be $550,000 based on recent comparables. You're hoping to refinance and pull out equity once the work is done. But here's the key question. How much will the lender actually lend you after the renovation? In most BRRRR cases, banks lend 75 to 80% of the new appraised value, but only if the work is complete and documented. The new value is supportable via comparables, and the property still meets the DSCR, the debt service coverage ratio, and rental criteria. In this case, that would mean the 80% of $550,000 is $440,000. If your total investment was $470,000 purchase price plus $30,000 in renos, you spent $500,000, you've only recovered $440,000 and you're still $60,000 short. So unless you bought lower or your after repair value is higher, you're not pulling capital out. You've just increased leverage, not liquidity. That's where most BRRRR deals break down. So what do we look for when hunting for a true BRRRR candidate in this market? First, you need to buy at a discount or in a way that adds some serious value. Think under-rented plexes, cosmetic fixer-uppers, or properties with mismarketed potential. Second, the renovation must be value-linked, not just aesthetic. Upgrading a kitchen is great, but converting a 5.5 into a legal 3-bedroom with closed walls and proper egress adds more appraised value. Third, the timing has to match lender realities. You won't get a refinance done in 30 days after renos. You need full documentation of upgrades, proof of market rents, leased or projected, and often a 3 to 6 month seasoning period before lenders consider the new value. If your plan is buy, paint, and refinance 60 days, you're in for a rough wake-up call. Most failed BRRRRs fall into the same traps. They overpay on the acquisition, under-budget the renovation, assume appraisers will agree with realtor opinions, or skip verifying lender rules on refinance timelines. The biggest killer? Hope-based math. You can't hope your after repair value is $600,000 because a neighbor sold for that last summer. You need comps, appraiser guidance, and lender alignment before you start. Also, if your renovation pushes you past the 65 to 70% loan to value at refinance and the property doesn't cash flow, the lender may reduce your mortgage approval or decline it altogether. Here's a breakdown of a BRRRR that my client just completed. He purchased an 8-plex in the Sud-West in January 2025 for $1.6 million. At the time of acquisition, the rents brought in just over $96,000. He spent the year negotiating with tenants and doing renovations. At the end of the year, he had turned over 6 out of the 8 units and spent $592,000 on renovations, closing costs, and tenant payoffs. Additionally, he had spent $46,000 in carrying costs. At the end of December 2025, the building brought in $165,708 in rents. That's a 72% increase from the time of acquisition. With the new revenues, the property appraised for $2.68 million. He took on a CMHC insured loan of $2.4 million on a 40-year amortization at an interest rate of 4.15%. After CMHC fees, he is going to end up with $2.27 million. To summarize, his total cost was just under $2.24 million, and he pulled out $2.27 million in just over 12 months. He now holds the asset, which continues to pay for itself, and he no longer has any money tied up in the property. This is how you execute a BRRRR to perfection in our market. A major BRRRR factor in our market is your timeline and team. Renovations in Montreal are slower than what you see in online videos from other provinces or countries. You'll need a good team by your side. This should include a general contractor or licensed trades, renovation permits where applicable, especially for structural or electrical, a clear timeline padded for weather and inspections, and the ability to carry your holding costs for 3 to 6 months minimum. Also, your mortgage broker needs to be looped in early to prep the refinance file. This isn't a surprise call you make the week after painting is done. So, is the BRRRR method a good idea? Yes, but in 2026, Montreal, it's a specialized strategy, not a default. You should consider a BRRRR when you can buy under market, you control rental cost and timeline, you can justify real after repair value via comps, and you've modeled the refinance using today's lending realities, not theories. If all those boxes are checked, it's one of the smartest ways to grow a portfolio. If not, you're just gambling with leverage. Here's the bottom line. BRRRR is a financing strategy, not a renovation dream. It only works if your math, your property, and your execution line up. If you want help building your BRRRR strategy, book your 15-minute investor call. We'll break down your purchase criteria, model the refinance options, and help you avoid the 4 biggest traps that kills deals. If you want to do this right, let's plan it together. The link is down in the description. If this helped you understand the reality of investing in Montreal, hit the subscribe, the like button, or drop a comment if you want more breakdowns just like this. I'm LJ Aguinaga, real estate broker, investor, and your partner in real-world Montreal strategy. Let's make your next deal a real one.